Good evening, everyone. My name is Stephanie, and I'm from the Office of Alumni Relations and Annual Giving. We're going to get started in a few minutes. Please feel free to put your class year in the chat and any questions that you may have. And then I just wanted to remind you all that we are recording this session so that it can be used for later. So I'm going to turn it over to Laura and we will get started.
Great. Thank you, Stephanie. I'm excited to, see all of you putting your graduation years, class of 2021 MBA, into the chat so that John and I can get a sense of who's attending this workshop. And it's great to see so much interest in a financial topic in general and in the debt topic in particular. Stephanie, do you want to wait a little bit longer, or should John and I start introducing ourselves and going through the presentation?
I think we can start.
Okay. So my name is Laura Rotter. I am a volunteer with My Money Workshop. Been involved with them, I think, for a little over a year. And I also run a financial planning practice. So I'm pretty deeply versed in financial topics. And my co-host this evening is John DeStefano. John, you want to introduce yourself to?
Sure. Hi, everybody. My name is John DeStefano. I am a newbie to My Money Workshop. I've only been doing this about a month or 2 months. But I have been in higher ed as a volunteer for the last 5 years. I help first-generation Americans land their first job out of college and have been a professional fellow in residence at Cornell for the last couple of years. I do this, my professional career before that was in market research for 25 years. I do this because somebody did it for me 40 years ago. I grew up below the poverty line and somebody yanked me out of line and said, hey, buddy, you should know this. So it's my turn to return the favor.
That's great. So My Money Workshop's mission is really to educate different populations. Tonight, obviously, Mercy College alum on your finances to help take the stress out of managing your money. So next slide, please, John. So we put you all on mute because you are a nice sized group. So just to make sure that the lines don't get muffled. So questions tonight. First, again, anyone entering, please say what year you are or year that you graduated. But so questions, if you have any, and we actually were given some questions even before we're starting, which is great. Please put them in the chat box. And I think you all got the presentation actually ahead of time. But for anyone who didn't, the Mercy College Alumni Department will share the presentation with you. Next slide. And here's our beautiful bio pictures. Next slide has My Money Workshop's mission. We're a nonprofit organization, and we host many of these workshops. Used to be always live and switched to remote during the pandemic, and now gradually moving back to live. And tonight, or today's objective, is really to give you some education and some tools for managing credit and debt. And if you already have debt, how to create a debt payment plan. And we'll share some additional tools to set up some goals and, as it says here, to learn to advocate. Next slide. So please use the chat to answer this question, just for us to get a sense of where you are on a scale of 1 to 10 in managing credit and debt. One being, frankly, that, you don't have any debt, and 10 that you are already managing, or you could just use words without, but just to get a sense of where you all are in terms of having debt that you need to manage. Eight, thank you, JH. 5, 7, managing but can do better. I guess if you're self-selecting perhaps to be part of this group, then it is something you're interested in learning about. And thank you everyone who's participating. I didn't quite define whether 8 is that you are having difficulty or you're having no difficulty, because frankly, I'm not even that clear, but let's go on. Next slide, please. This slide just sort of, or does show the different topics that my money workshop deals with. Tonight, again, we're dealing with debt, credit and debt management, the little box on the left, but we deal with budgeting, setting goals, banking and savings, and all different aspects of your financial life. So starting off by saying, have a financial checklist. And what do we mean by that? Know what you spend each month. So have a sense of your expenses. Create a budget so that you understand what's coming in and what's going out. We're going to talk tonight about being careful with credit cards and, frankly, managing all debt. Have a bank account and review it regularly so that if there's charges you don't recognize, you'll see them, and you have a sense of what your recurring monthly expenses are. Saving regularly, paying yourself first, in other words. Paying taxes on time. This is the time of year where I hope everyone is getting their information together and filing their taxes. And again, you have this slide, but there's a number of things that are part of a strong financial checklist. So here's the same question that I felt we were sort of asking before, but it wasn't clear what the numbers of what the rating numbers were. So please put in the chat box if you have credit cards as opposed to debit cards, actual credit cards. And in addition to credit cards, if you have debt. And the most likely debt I would assume you guys would have is student loan debt. But certainly there's other kind of debt. One credit card, student loan debt. Yes and yes. Yes to both, credit card and student loan. And a car loan, yes. Credit card and student loan debt. Yeah, if you're part of American culture, you are likely to have at least one credit card. And often, as you're putting in student loan debt and car loans. Certainly, and as you progress in life, a mortgage. Next slide. So first of all, let's define what we mean by credit. Credit is when somebody, this definition on this slide is receiving something of value now and promising to pay for it in full later. But I think of credit as a loan. Somebody is lending you the money so that you receive something of value now. And you say in return, I'm going to pay you back. And often doesn't just mean paying back the amount borrowed, which is otherwise known as the principal amount, but the person who lends you the money wants to be compensated. And so you're also going to pay interest if you don't pay the amount. Well, actually, as you pay the amount with credit cards, you have a certain period of time to pay without incurring interest. But with any other loan, student loan, auto loan, mortgage debt, you're going to pay interest in addition to paying back the principal amount that you've borrowed. It's the cost of borrowing money. And this last line, it can be simple, which is you pay the interest expense always on the original amount, or it can be compound, which is the interest grows and you will be charged interest on the interest over time. And if you have any questions about this, please put it in the chat.
You know, Laura, I wonder if we should take a jog onto the danger of compound interest versus simple interest, because I know you and I both know what that's like.
There's a slide that will get into that, right? The one that talks about the coffee, but and I guess, and you might have heard this before, compound interest is a beautiful thing when you're saving, and especially when you begin to save when you're in your 20s and other early years, because you know what John's saying and what we'll illustrate further on, it's dangerous when you're the one owing the money, so that if you borrow $100, I'm going to use easy round numbers, you borrow $100 at 10% interest, and you don't pay it back on time, suddenly you're paying 10% interest on the $110. And then you're paying into it. And so the amount you're paying compounds, grows, and it's dangerous when you're the borrower. And on the other hand, it's wonderful when you're getting compound interest on your savings. It's why we always encourage people to start saving sooner rather than later, because of the beauty, if you will, of compound interest.
That's exactly where I was going.
Yeah. So there are two types of credit. Installment credit, which we note here, is like a car loan and a mortgage on the date of payment, on the date of purchase. You know exactly what you're borrowing. And ideally, it goes down over time because you're repaying the loan, otherwise known as the credit you received over time. On the other hand, a credit card is a form of revolving credit, which means that you're given a certain amount that you can borrow. Let's say, again, you're told you could borrow $1,000 over the course of the year. Often it's larger. So you can borrow an amount, repay it, and that $1,000 always remains available to you, or the full amount of revolving credit always remains available to you. And the amount that's due each month, as opposed to you've locked in place a payment plan for your mortgage or your car loan, the revolving credit, the amount that's due is going to vary based upon how much you borrow. You don't, as it says at the bottom, you don't have to provide your income information, etc. Each time you borrow. You always know how much is available to you. So here's the slide talking about the difference between simple interest versus compound interest. Compound interest, as we said, is calculated on the principal amount in any accumulated amount of interest from previous periods. So so that 10% is going to be larger and larger if you allow the interest to accumulate. So it's almost a snowball effect. So if you don't pay the lender on time, it's pretty scary with a credit card, for example, because the amount of interest due on a credit card is often 25% and can even be higher. So you can imagine how the amount you owe just grows and grows. And I hope you all know this, if all you're doing is paying the minimum balance each month. So to the extent that you pay your credit card in full, well, first of all, credit card, again, is very different than a different loan in that if you pay the entire balance within the allowed period of time, generally 30 days, you don't owe anything. But if you start to accumulate interest expense, it's a pretty frightening thing. So, and again, we're talking about credit tonight, but want to emphasize that as a saver and an investor, that compounding of interest works to your favor, especially when you're young.
I just want to underscore the paying off the credit card bill in total. It's one thing if you actually don't have the money to pay off the credit card bill in total. I totally get that and have been there. But credit cards are funny in that they say minimum due, and you could fool yourself, particularly when you don't have the money in your pocket, which I have not had many times, thinking, oh, okay, I'm paying the minimum. But you're accumulating interest in a compounded way when you're not paying it off in total. So just know that red line.
Yes. And we'll discuss that more. We also have a picture of what a credit card bill looks like. And it's quite confusing because, it's current balance owed, minimum balance. When it's your first credit card, what is necessary for you to pay can be very confusing. But as John said, if you can help it, and we will talk about how and why you should help it, don't just make the minimum payment due. So now we'll discuss debt management. Love this picture. How do you even start? Next slide, please. So debt, or as could be used interchangeably with credit that you've received, is anything that you owe. Even rent, though generally you pay rent up front, but rent, a mortgage, certainly, student loans, credit card payments, even medical bills. If the doctor allows you to leave the office without paying up front, you've been extended credit. And I just want to make sure that it's clear that, yes, all of the above are considered debt, but there's good debt and bad debt. So, for example, a mortgage is, generally a pretty low interest rate because it's backed by the actual home, so that if you don't pay over time, the bank is just going to foreclose on your home and sell it. And it's good debt because you're locking in place your cost of living, as opposed to rent, which can rise with inflation. You've locked in a monthly mortgage payment, and over time, as you make mortgage payments, you're actually owning something. You're building equity in a home. The same thing with student loans. At your age, your largest asset is your earnings power, and to the extent that you've given yourself a good education, so that you do have the ability to earn a nice living, you paid for it with student loans, which also are generally lower interest rate than a credit card. And medical bills, you don't have choices for medical bills, but there's good debt and there's bad debt. And accumulating credit card debt is bad debt. Navigating student loans, when I first saw this slide, says that 75% of recent U.S. college grads have a $30,000 loan as they enter the workforce. I've advised many people who either have or are thinking about taking on student loan debt, and $30,000. If that was the amount that I generally see people graduate with, that would be great. I always advise people to look at how much you think you're going to earn your first year out of college, and over the 4 years, don't take more than that first year of earnings. So $30,000 would not be a bad loan. I see people who are not going to earn much more than $30,000 who graduate with $100,000, $150,000 of student loan debt, because there's no one that says, what are you doing? This is going to burden you for years and years. But so $30,000 would be a great amount of debt to graduate with after 4 years of college. But I guess this is an average. So there are as many people below as there are above. And so, yes, you can have a sample repayment plan of about $200 a month if you get a $30,000 loan. Happy to discuss more if people have questions in the chat. Next slide, please. Student loans. So right now, anyone who has a federal student loan as opposed to private student loans, you've benefited from the CARES Act that was passed during the pandemic, in which you the payments on your loans, which you often start to pay upon graduation. Well, anyone who has graduated during the pandemic actually hasn't had to make any payments yet. May 1st is when payments are expected to begin again, unless it's extended by the Department of Education. We recommend that you sign up for auto pay for this and frankly, any loan that you're repaying, so that you don't wake up and go, oh crap, I forgot to make that payment, that you've put it to automatically debit your checking account and pay. And often the loan servicer may give you a discount if they know that you've signed up for auto pay and it's going to automatically come out of your checking account. If you can, and this depends on what other debt you have and what the interest rate on the student loan debt is versus others, but if you can and you have excess cash flow, make more than the minimum payment rather than sitting with too much cash in your bank account, let's say, because right now savings accounts at banks are not even paying 1% of interest, and you are likely paying way more than that on your student loan debt. So it's a good investment to pay back student loan debt. And if you have multiple loans, you may be able to refinance, but there's reasons why you don't want to refinance federal student loan debt with private student loan debt. And so each particular situation requires really often talking to someone, an investment professional who has knowledge about student loan debt before you leave the federal government. If you had private debt, for example, you wouldn't have gotten this deferred payment. And federal government can also be set up to have repayment plans tied to your income. So definitely reasons to think and speak to a professional before you refinance privately.
So there's a challenging question in the chat. Just see if I can read the whole thing. I completed my associates and my BS at Mercy. I went back to graduate school and completed my MS in occupational therapy in 2019. Now I have 140K in student loans, exclamation point. Completely understand. How will I ever be able to pay this back and actually buy a home?
It's a good question. I don't have a sense of what your other expenses are and what your income is. We'll be talking about setting up a debt payment plan, and as I said earlier, when the slide said an average $30,000, you know, that would be nice if that's what I see most people with. I often see most people with balances like yours, and I don't know what an occupational therapist earns, and don't know how close to $140,000 it is, but that, yeah, for better or for worse, there's no one that gives us advice when we actually go in to borrow the debt. It's quite easy to borrow student loan debt.
So I just want to add into that. The CARES Act and the debt relief is still undergoing discussion in the legislature. I just read an article today about that. So what I do, if there's a topic in legislation that affects me personally, I set my Google alerts. So if anyone doesn't know how to set a Google alert, ping me and I'll tell you how to do it. But I set my Google alerts, whether it's weekly, daily, or otherwise, on that topic. And I keep myself informed so that I don't have to rely on other sources, the New York Times or the federal government telling me. I know it because I'm actively searching out that information.
Right. And I don't know if, who put it in the chat, Marcella, if you have private loans or public loans, but certainly it's a great recommendation from John if you have federal loans that paid. And I see a question, is it okay to do income-based repayments? Again, not knowing your individual situation, but I think income-based repayments are definitely something often worthwhile to take advantage of. And do student loans affect the ability to buy a home? Any lender is going to look at your monthly obligations, as opposed to student loans, which are really easy to get, whether or not it makes sense to take the amount. Mortgages are much harder to get, and they're going to check how much income you have. They're gonna do a lot of due diligence before you're able to borrow money for a mortgage. After the 2008 crisis, which began because of people taking on too much mortgage debt, it's become much harder to borrow. So yes, it can impact your ability to get.
I love that we're getting so many questions, and we're getting, again, as the newbie here, challenging questions. Rita asks, I'm in a loan forgiveness program and was instructed by federal loan to begin repayment despite the forbearance. Your thoughts, please.
I'm not an expert in student loan debt, so I would, inquire of someone who does work with people on student loan debt for often and always. My first feeling is like, well, if that's what you were instructed to do, I would do it. But but that's just sort of an intuitive response as opposed to a knowledge-based response.
And I just want to underscore on the slide this URL. I'm not always a fan of government literature, but you guys are all bright people on the other end of this call, and you can assess for yourself when you go to this website if it passes muster.
Yeah. Next slide, please. So specifically this question, and certainly you don't have to, it's just a question, a yes or no question, but do you know if you add up between what's outstanding on your car loan and what's outstanding on your student loan debt, how much you owe, and certainly what's outstanding on any credit cards you have? So I see a yes, I see two no's. And it's certainly important to know. I don't believe we discussed this in detail in the slide, but in general, knowing what your net worth is, and net worth, I don't know if any of you took an accounting course, but you've got your assets, which generally for people like us, it's how much cash we have in the bank, how many investments we have. And if you're working, you might, have started to invest in your company's 401k, in that, 401k that's provided by your company to invest in. That's an asset. So your bank accounts, your 401k. If you've purchased a car, that's an asset. And of course, if you've purchased a home, that's an asset. So you add up the assets you have and you subtract from that the debt you have. Often, if you've just relatively recently graduated from college, you use student loan debt, your debt may be larger than your assets. But so knowing what your debt is and against it, what you own, and against it, what the liabilities you have, it's important to know where you stand as you look at your finances.
And I'm just going to chime in that it's easier to do than you think. Like literally, we could do it on a piece of white paper in 10 minutes.
Right.
It doesn't require, particularly at this stage in our lives, right? You guys are all mostly under 30. It's not like you're in a couple of yachts and 6 different houses. And it's a good exercise. If you're one of the no people after this class, take a white piece of paper and write it down.
Yay. I'm not sure how to pronounce your name, Yajera, but I saw you held up a piece of paper.
I love it. I love it. I love it.
Yes, it's a good thing to know. And as John said, it's really not rocket science. It's addition and subtraction. And it's nice if you do it, over time to watch it grow. So either because you pay down your debt or you're saving more. Or both is even better. So here's the response to, the question of how do we reduce the debt? And as we said earlier, borrowing isn't necessarily bad. I mean, that's how you get an education. That's how not many people actually go out there and, pay $40,000 or whatever for a car. You borrow money over time. And of course, you borrow money to purchase a home. And also you need to be a borrower in order to be a borrower. People need, lenders want to see that you have a repayment history. And so it is important to have a history of borrowing and paying back on time. But if you have too much debt, as we saw earlier, if nobody if advice wasn't there when you took on the student loan debt, you may have too much debt and it can overwhelm your budget. And as we said earlier, if it's credit card debt with a very high interest rate, it'll overwhelm your budget and it'll hurt your ability to borrow going forward. Next slide. And one comment I want to make, I don't know if it'll show up exactly on a slide, but often, so first of all, look at the debt you have and write down what you owe and understand what the interest rate you're paying on the debt is. And so often advice will be, pay down your highest interest rate expense first. But I would also make the comment that money is an emotional thing, right? Like there's a lot of anxiety around money, a lot of worry. And so sometimes you might have a smaller balance on, let's say you have several credit cards and you have a smaller balance on a card that has a lower interest rate, but it might make you feel better and therefore motivate you to continue to pay down your debt if you completely wipe out that smaller balance on that one card. So I've certainly seen from sort of a more behavioral approach to repaying debt that it's not always the highest paying debt. Perhaps it's the lowest balance debt you want to pay off so that you get excited and you motivate yourself to keep paying it down. But even to make that decision, look at the debt you have and see what the balance is in each debt, each either credit card and or car loan, and then the interest rate. And understand why you're in that debt. Was it good debt that you're happy that you took, or bad debt that just circumstances got the better of you and you just accumulated?
I just want to make a comment about how we get into debt and, big numbers of student loan debt and why that happens. And I'm just going to collapse this into two sentences. If borrowing money for college was like borrowing money for a house, there would be much lower student loan debt. And you will discover this, that when you go to take $150,000, buy a house for $150,000 and take $100,000 loan, you will be inundated with details about your creditworthiness. Unfortunately, in this country, there is not the proper guidance at the college and post-college level. So I'm responsible for myself when I take a loan out. But if the guy on the other end of the table says to me, sure, just sign right here, it's not all my fault. So I just want to give a little bit of solace for student debt.
I love that, John. Thank you. It's very, very true. So here's a sample worksheet. I'm sitting here with a note, a lined notebook on my desk. It'd be easy to set this up yourself. It's very, very helpful if you have various sources of debt and you're not clear and you haven't thought about exactly what's due, exactly what the interest rate is, how much are you paying each month. So please use this. You can get a Google Sheet. You could just use a pen and paper and make a list for yourself. I actually learned this while going through the slides for this presentation, that if, for example, you know that you get paid on the 15th of the month, and yet your bill is due on the 10th of the month, and you have trouble having the discipline to make sure you have the balance available by the due date, you can call the credit card company or the car loan company that lent you money to purchase your car and say, you know what, I'd like to have a different due date. And so that I never knew. I just assumed you had it set up to pay it exactly when they've dictated you have to pay it. And of course, this I did know, that if you are struggling to make payments, it's always worth a phone call before you end up being in arrears, to see if you can set up a new payment agreement. It may not always be possible, but it's always worth a phone call if you're struggling.
Yeah, so true. And I didn't know that either. And it's so valuable.
Yeah. Next slide. And I'm laughing because when we talked earlier about, you suddenly realize you realize you can't make more than the minimum payment on the credit card. When you have a credit card, and it sounds like pretty much everyone who's on this call does, be very intentional about your spending. It's not now I can buy anything I want. Vehicle, it really should be a vehicle to just not have to carry the cash around in your wallet. And to be honest, I've started to use my debit card more than my credit card. I mean, we're enticed to use credit cards so that we can get travel rewards and cash back, and that is valuable. But if you know yourself to be someone who has trouble sticking to a budget, carry around a debit card. It didn't exist when I was your age, but now it's just like a credit card, but it's going to be declined if I don't have enough money in my bank account. So make sure that you understand the fine print, that you understand when you need to make payments. And if you can set up auto pay, that's great. It's harder to do when the balance changes each month, but just be sure that you're always spending within your means. And then the last comment, if however you didn't, you can consolidate. Again, this is going to depend on your ability to be able to qualify for new debt. But, if you're having issues repaying, get a 0% credit card, again, you're not going to be able to qualify for it if they see you have too much debt. But, any way possible to lower the interest costs, which we discussed at the beginning with compounding, can just really be frightening and snowball with credit.
So just a quick illustration. Can everybody see my pie? Laura, can you see my pie?
I can, but I can't see what's in it. I
Okay.
can see you have a
So
pie.
everybody should know what their budget pie is. It only takes 10 minutes to make a budget pie. In your budget pie, you have things like your share of loans in your expenses, your food, your entertainment, your utility. I guarantee you, after this call, in 10 minutes, you could make this up. You don't need a spreadsheet. We all know how to use spreadsheets, but you could all do this with your iPhone and your calculator, your iPhone calculator, and just draw it out and learn for yourself. Is 20% of your expenses on loans? Is 50% of your overhead on rent? And the reason why this is so valuable is it will tell you where you have money available that you could save to pay off debt.
I always thank you for that, John. And to go even more particularly, I love the rule of thumb, which is often very hard when you first graduated, and even more so if you live in the New York metropolitan area. I don't know where all of you are located. But ideally, all your have-tos, which are going to include your monthly payments on your loans, which is going to include your rent, which is going to include your Netflix, which is going to include, whatever you have to, what I say you're going to pay for, even if you decide to sleep all month. Ideally, that's not more than 50% of what you have available to spend, because you want to pay yourself first with at least 10%, if not 20% of your income. You almost want that auto saved out of your paycheck, and then leave room for the fun. And I frankly say I put grocery spending under the sort of discretionary, because you could go to Trader Joe's, or you could go to Whole Foods, or you could go to Costco. And so you do have discretion in what you pay for your groceries, but you want to have room for fun, or else you're gonna put more stuff on credit cards. So it's harder to change those have-tos right away, but might make different decisions about housing, or different decisions about how much debt you're going to take on if it's going to push you way above 50%.
Love the rules of thumb.
Yeah. Next. So managing your debt, exactly as John and I are saying, it comes down to managing your budget. And it might take a while to pay down your debt, but seeing your debt decrease will make you want to reach your goals faster. And just as I read that sentence, again, why perhaps behaviorally, sometimes you might elect to pay a lower interest rate debt that has a lower balance, so that it's off your sheet and you get this sense of accomplishment. So know why you're choosing maybe to pay more towards one outstanding liability than another. And the easiest thing to say, and often the hardest thing to do, is keep your wants in check. That's why having a budget, especially for your discretionary, your wants, is so important. I use a debit card so that I can say, oh, well, I've already spent on what I hope to spend on wants this week. So maybe I'm not going to buy that new pair of shoes, or nowadays it's, that new pair of sweatpants. But, it's important to keep your wants in check.
And I so agree. It becomes a point of personal pride. Look, if whatever debt I have, I can't wipe it away tomorrow, but if I could shave 5% off a year, and I'm meeting that goal of shaving off 5% a year. And for those of you who like the spreadsheet, do that spreadsheet over 20 years, you'll see real money, real like down payment money on a house being saved just by meeting your goal every year, so that it's not some insurmountable, morass, but it's something that you can achieve every month and every year.
Right. Next slide, please. Right. We said it's a 30-day loan. It's not free money. So don't buy what you can't afford to pay back. Next. And, there are good things about it. Helps establish credit, and it's good in an emergency. You're protected in case of fraud more than a debit card, but I do know people who have been reimbursed in cases of fraud on their debit card. But it's more in the fine print in a credit card. And you get rewards for spending. But the bad part of a credit card is, if you don't have the discipline, you really risk accumulating debt. And here's the maxing out a credit card slide. It also includes late fees if you don't pay anything on the credit card. But let's say you buy a $2 coffee in this example, and then you have 4 cents of interest expense the first month as well, in addition to a late fee. But the second month, you see, it's already gone to 74 cents of interest expense. So, and of course the late fees. So you suddenly have a $73 cost of coffee. This is a true story. So the moral of the story, not surprisingly, pay on time and pay in full.
Love it. Love it.
Next slide. Curious is if anyone has had a similarly bad credit card experience. And you don't have to share the whole experience. You could just say whether or not you did in the chat. But we'll go on while we wait. Next. Not surprisingly, credit card companies are not charities. They're actually, looking to make money on the fees. There's an annual fee for not every credit card, but the credit cards with rewards, travel rewards especially, often have large annual fees. $625 for an annual fee. Not sure, but yeah, there are definitely credit cards that have those huge, that have those huge annual fees. So be sure that what you're getting from that card is worth that huge annual fee, because there are many cards that don't have an annual fee. There's a fee if you take cash advances. A lot of credit cards, if you use them overseas, will have foreign transaction fees. So if you're going to use your card overseas, see whether or not you'll be charged. Balance transfer fees, over the limit fees, late fees, and of course, finance charges. Again, it's not a charity. Credit cards are happy to take your money. Next slide. And there are different types of credit cards. And I think the one that not everyone is aware of, it seems like you guys already have credit cards, but often if you've just graduated from college and you have no credit history and you want to build a credit history, I know Discover is a bank that does this a lot. Will say, okay, great. Give us $500. It'll sit in an account that we have access to, and we'll lend you $500. So number one, you don't have to carry around the cash in in your wallet. And number two, they'll see that you pay on time. And so over time, you'll no longer need to keep the cash in the bank account as security. Store credit card, you're aware of. Bank card is most of the credit cards that are issued by Chase or Citicorp or Discover, which is a bank, and other banks. And a prepaid card is you might have gotten these as a gift. You might get an American Express gift card. So someone's already given American Express the money and you receive it as a gift and have it available. Next slide. So another tip for managing credit cards. If you've exceeded your budget, don't make another purchase on the credit card. And there's a sort of a non-intuitive recommendation. Also, don't cut up or cancel the credit card once it's paid, because one of the determinations of your credit is how much you borrow against how much is available to you to borrow. Ideally, the credit card companies don't see you borrowing more than a third of what you have available. So again, just for the sake of round numbers, if you have $1,000 credit line, I've advised people to, borrow 300, then repay it, then borrow 300 again, keep your utilization low. So if you decide I have 2 credit cards, I'm going to call and cancel one of them, that's actually going to be a negative hit to your credit score, because your available credit will go down if you keep borrowing the same amount. So it's a non-intuitive. I've sort of told people maybe cut up a credit card once you've repaid it, but don't cancel it so that the credit rating agencies will think you still have the available credit. Next slide, please. And protect yourself. Know how to lock a credit debit card when lost. I think the credit card companies have actually made this easier.
Should we put the 3 credit card agencies in the chat?
Sure. Yeah, the credit rating agencies?
Yeah. So
Sure.
Experian, help me out. Transamerican.
I don't know. I recommend it's free to go on creditkarma.com.
Oh, great.
Credit, the word credit, and then KARMA, and they'll compile the different, thank you, your different ratings from the different agencies. But while you do that, John, so we're coming up on 11 o'clock, if you could advance the slide.
Sure, sorry.
No worries. So here's the key takeaways as we get towards the end of this session. Either, use a Google Doc or a piece of paper and a pen, but write down how much you owe, and also write down how much you own, so that you can get to a sense of your net worth. Think before you spend and take on more debt, and most specifically when it comes to credit card debt, really don't spend it unless you know you can pay it in 30 days, and enact a freeze when necessary. Don't cancel the credit, but cut up the card or put it in a drawer. Don't use your credit cards when you know you've already spent too much. It's essential to pay it on time, especially when it's a high compounding interest rate, and be informed, be wise. So does anyone, thank you, Noel, also annualcreditreport.com. I will say Credit Karma, free credit ratings report. They do they'll make recommendations for you. They obviously, since they're free, so they're sort of selling like, this would be a good card for you, or this would, but I use Credit Karma and I just ignore it. But know that they are gonna, try to give you advice. Are the slides going to be shared, Rita? I actually thought the slides were shared ahead of time, but if not, I know that the alumni office has the slides, and I'm not sure if it's automatically sent out afterwards, but it's available through them.
We're going to send a thank you email in a few days once we have the recording. So we'll make sure that we send the slides with that.
Perfect. So it's not recommended to close a credit card account after you finish paying. So Jennifer, I see your question. I'm not sure exactly what you mean by after you finish paying. As we said earlier, a credit card is revolving credit. So if you're specifically asking about a traditional credit card account, there's no such thing as finishing paying. So you always have that credit line available to you to draw down. If you've gotten in trouble and you know you have issues with discipline, I'm saying, yeah, I still wouldn't recommend actually calling and formally closing the account, because that's going to hurt your credit score if you continue to borrow similar amounts. I would recommend, if you feel like you have issues with discipline, even if you hide it in a drawer somewhere, then just cut it up. So you're not using it, but you're also not lowering the denominator upon which they're going to base your credit score. You still have that line available to you. You just behaviorally are, taking away your ability to borrow. Yeah.
And just in the last minute,
Inactivity fees. I'm not aware of inactivity fees. I have a Target credit card, and since the pandemic, I haven't been there. I know I just got a note that they're going to shut my card if I don't use it within 30 days, but they didn't say they were going to charge me anything for not using it. So I'm sorry, I'm not familiar with inactivity fees. Yeah. Perhaps they will close your account or load. That is true. Like I said, Target probably closed it already, because I just haven't been back since
not shopping every day during the pandemic.
Yeah. That again, and yes. So I'm seeing that people have definitely had accounts shut down if they haven't made a purchase, but that's preferable to making too many purchases and not being able to repay. So I don't see any other questions. I hope this was helpful. When you get the slides, there is information about assistance paying bills, and then just generally, I think in the next slide, there is information on other resources, and also, resources we give. And yeah, how to read a credit card. I don't know, John, I think there's a couple more slides that show my money workshop resources.
Yeah, thank you.
And as well as a simulated. The slide before is interesting as well, right? A credit card payment simulator. So if you put in your credit card balance, I hope you don't have one, but if you do, and you put in the interest rate, and it'll show you both how your minimum payment is calculated, and then if you're making a fixed monthly payment, how long it's going to take you to pay it off, and how much you're going to pay over that time in interest, which is pretty frightening. It might also work, as I think about it, with a student loan balance. If you put in what the interest rate is and how much you're paying, it will tell you how long it's going to take you to pay it off and how much interest you're going to pay. It shouldn't be quite as frightening as a credit card, but it'll be a higher balance, though, a lower interest rate, but a higher balance. Anyway, it was a pleasure to do this, and hope this was helpful.